Hello, good evening, everybody. Welcome to Headways Capital's presentation of how to find a great real estate deal as a passive investor. My name is Stephen Degami. I am a new partner at Headway Capital in the investor relations. Next slide, Brian. If you guys want these slides to know how to find a great deal as a passive investor, text us at 281-559-7061 if you want these slides. Let me go through our disclaimer. This webinar is for educational purposes only and should not be considered as legal or accounting or investment advice. The information in this webinar does not represent an offer to sell or a solicitation of an offer to purchase an investment or security. Please consult with your own attorney, financial advisor, CPA, or legal matters, investments, and specific tax questions. Just want to get through that. So about Headway Capital, let me talk about myself real quick. I am new to Headway Capital. I just joined this year, but Headway Capital has been around since 2018, led by our founder and CEO, Sid Shamin, and his wife, Amin Amir. And Brian Alfaro is our Director of Investor Relations. Next slide. Yeah. So a little bit about Headway's track record. Headway owns over $500 million worth of assets under management. There are over 3,300 units under management, and we typically return an average of 25 to 30% average return per year. There are over 430 active passive investors investing in our investments. And this is how we produce results. We are a focused, purposeful, consistent, and disciplined organization. We are focused on our, we are focused on our investments. So we are only in multifamily and have just a few investment types. We are purposeful in how we approach our investment, and we are disciplined and always looking to add value to our investors. We also are consistent in our approach to investing, and we try to make sure that we keep our assets and consistently managed. So here we are talking about how to find a great deal as a passive investor. I've been a passive investor for a few years now. I started investing in 2018, and I've looked at many deals. And really, this is kind of my way of trying to show you how I've been looking for deals over the last 7 years. And this webinar kind of really is for somebody who's new to looking at investments, and maybe you've seen a couple offer letters and you're not really quite sure what you're looking at, and you're wondering, is this investment right for you? So the first thing that you're going to always look at is price. It's the thing that's going to jump out at you the most. It's how we really evaluate things, right? If an investment is a good deal. So some of the numbers that we kind of look at are price per door. Price per door is actually the price per unit on an investment. So for example, if a apartment has 100 units and it's a $10 million property, the price per door is $100,000 per unit. So with that, you can kind of compare apples to apples on units or on properties. So if a property is worth $200,000 per unit, you can compare that to a property that's worth $100,000 per unit. Now, what does that all mean? Generally speaking, if it's cheaper, maybe it's not as good as something that's worth more, right? So you really have to kind of dig deeper than that, but that really gives you a baseline of the value of a property. The next number that we look at a lot is the cap rate. That's really um, the rate of return on investment. So, if generally speaking, most cap rates are between, let's say, 3 to 10%, let's say. So really, it's the how much you would earn if you per year if you invested if you bought out a property outright. And the way that the cap rate is calculated is by using the term NOI, net operating income, which is the amount a property earns minus all the expenses, not including the how much debt they might owe on that property. And you take that number and divide it by the value of the property, and that'll give you a cap rate. Now, what that means is that a cap rate that has a higher cap rate has maybe a higher return than something that has a lower cap rate. But at the same time, in general, a property with a higher cap rate also has a higher risk level. So when you're looking at a cap rate and it is fairly high, the returns might be higher, but you're also taking a greater risk. So how do we make money on a multifamily investment? So the way that we make money on a multifamily investment is investing in a property that might need some work and that we can improve upon that property so that the value goes up. We try to increase the NOI of that property, and that raises the if the cap rate is kept consistent, that raises the value of the property, and then we sell for a profit. So, what's the basics of this? One, buying in the right area that has growth, and two, buying buying a property in which you can increase rents or increase the value by rehabbing and stabilizing the property. Uh, Next slide. So again, buying in the right area. So location, location, location. It's one of the trite uh, expressions used for real estate in general, right? Uh, so as we look at this map, this is a map of the United States uh, and the major metropolitan areas from 2000 to 2022. This is a couple of years ago, but still, data is still relevant in terms of growth. And if you look at this map, you can see different areas in the U.S. where there is growth, and those cities and metropolitan areas are places like uh, Phoenix, Arizona, Las Vegas, Seattle, Dallas, Fort Worth, Houston, Austin, San Antonio, forgot that town. Yeah. Atlanta, Georgia, uh, Charlotte, North Carolina, um, and all the Floridas, right? Tampa Bay, um, Jacksonville, Orlando, Miami. So really, all these areas are you want to invest in an area that's growing, and what that growth does is it really, if you remember in basic economics, your supply and demand curve, you are increasing that demand curve, which increases prices over time. The other part of location is, investing in a state where um, you have good uh, landlord rights. Uh, I think we've all heard of horror stories of squatters in different properties, and there are ways to avoid that, and that's investing in states that have good landlord rights. So states like Texas, Florida, Georgia, North Carolina. For example, Texas has a 3-day to eviction. So if somebody's late by 3 days, you can send them a notice of eviction, and you can get the ball rolling to get somebody who's not paying out of your property, and that really helps drive NOI. The other thing is with location is the submarket in a town. Something. Let's take Dallas for example. There are submarkets, there are areas that are better and worse, right? Um, how do you know that? Well, some things that make a area worse are crime rates, obviously, um, low rental rates, high um, high vacancy. So those are all indicators of bad or worse areas. And then you have headwinds that are going to help your property. That's like new construction in that area, either more apartments or more retail, um, and new employment. If you see things about a new employer moving into town, that is a huge tailwind for job growth, which also increases the value of your property. Mhm. Uh, Next slide, Brian. So, the really other part of the of owning real estate is really uh, trusting the partner group that you're investing with, and really that trust comes through experience. Knowing that the apartment group has gone full cycle, and of which so full cycle on a property means that the property has been purchased, correctly operated, and sold. Those are the major phases of owning a property, and the experience of going through all those portions of property are really would give you confidence knowing that you're investing with a good operator. Um, you know, kind of details in those plans are really, uh, creating and executing a business plan, which really is being able to identify a property, underwrite it correctly. That means evaluate the value of the property correctly, get financing for that property, do the daily operations, which include finding good tenants, creating communities in that area. So it's really important to find a group that can do all these things successfully. Just an example here at Headway, you see 18 properties, I think, that are under current ownership. You can see these on our website. So, we do have quite a bit of experience here at Headway. So the next part of this is the purchase. Um, how does the managing partners purchase their property? So Uh, one, you want to know that the managing partners are they have a plan. They have a clear expectation of what they're buying. Here at Headway, we are looking for Class B properties. That means, let me give you a little background on asset classes for apartments. So Class A would be your high-rise downtown luxury apartments. Class B is a workforce 2 to 3 story apartment building, typically with pools and other amenities. And then your Class C is the maybe not the best area or the best place to live. There probably aren't very many amenities. It's just a place to live. So we like to invest in the Class B asset, and we want to look for actually a Class B asset that has maybe it needs to be refurbished. It might be a little bit older, 19 built in the 1980s, 1990s, and it's time for somebody to come in and remodel and and bring the property uh, up to the market. So in that, you're looking for somebody who can locate to get the right purchase price. And buying at the right price means that um, they are, I mean, obviously you want to try and buy as low as you can, but really knowing what you're getting when you buy a property. And part of that is being able to get in first in line to buy a property, being able to get to a deal before it gets to market, so that you can have maybe some leverage on that property. Uh, so next, like talk about the location and submarkets, right? You want to invest with a group that knows where the property is located. And what I mean by submarket again is, we have those major metropolitans that we talked about earlier. There are different areas that are better and worse, like we said before. So knowing that investing with a group that knows their submarket and knows the best places to buy uh, is is definitely beneficial to you as the investor. Um, they also should know, the history of that area and what, if there's crime, is it gentrifying? Those kind of things are hugely important that your investor group should be able to explain to you. And then in that, digging down closer is the actual asset apartment of itself, right? What's going on in that apartment? Um, are there um, are there things that need to be done, right? Again, next the value add plan. Uh, what are they going to rehab or fix in that property? Do they have a clear plan for those rehabilitations? Also knowing, if there's going to be major expenses, things like roofs and ACs are very expensive, and making sure that the partnership group knows if they have to make those rehabs. Also in the purchase is really debt structure is huge. What are the rates they're getting? Are they getting low rates, and how much time and term do they have on their rates? And does that term equal the amount of the duration of their plan value add plan? Uh, that's also very important to know. You also kind of want to know if the ownership group has some skin in the game. Are they investing alongside you? Are they putting their money where their mouth is by investing with you? So I think that's also a hugely important part of knowing what's going on, or sorry, what's um, having confidence in your investment team. So next, really the execution, right? Knowing, uh, following through the execution and being with a group that knows how um, to follow the plans that they outline for you. So really, being able to build a team, knowing that your sponsor can build a team, and that includes their asset managers, the people running the property, or and the property managers, CPAs, lawyers, contractors, lenders, having all these things lined up. And that's really, again, with experience. Experienced sponsor will have all these people lined up to make sure that they can run the property correctly. Again, I want to highlight property management because that is huge. They are the front line in terms of dealing with tenants and major problems that might come up on the property. So having really solid property management is can make or break a deal. Um, and also having their capital improvement plans solidified, and making sure that the contractors they get are going to execute the plan on time and on budget. Um, Also knowing if they have risk mitigations in place. There could be things there. Actually, there will be things that go wrong with almost all properties. You have, you know, 200 units in a property that's like 600 people, maybe in a small area. Something's going to happen with that many people over a few years. So make sure that they have risk mitigations in terms of, do they have capital set aside for things that might go wrong? Um, do they have their debt structured again so that they have time just in case their capital improvement plan goes a little bit longer than first expected? Um, is there insurance? Like is the insurance structured properly so that they can cover their major expenses? Um, and then also really with execution is making sure that they have a clear exit plan. They should outline a good exit plan for you. So when you look at the deal. Um, Next slide, Brian. Another hugely important part of trying to find a good property is the communication of the sponsors themselves. Um, first the first thing you'll see is the information of the property offered to you. And do they give you really detailed numbers on what they're trying to do, or is it really all fluff? I mean that's something that we can talk about maybe another day in another webinar, but all the information should be in their offering, and if it doesn't have a ton of information, then uh, you need to either ask them questions or really question if you want to invest in that investment. The other thing that they should actually have in their information is are they giving you guys are they going to give you updates on their property? um you know so typically you should get monthly updates on what's happening in on the property, and that should be detailed financials of how much they're earning and how much they're spending. um it could be other things like rent roll or other information, but they should be giving you detailed financials. And also the ease of contact. You should really try to, before you invest with somebody, ask them questions. Make sure they are able to, well, or be able to get back to you quickly, but also make sure that they build confidence or they build confidence in how they communicate to you. And with that is education, right? Do they want you to be educated? Do they want you to know as much as you can so that you can be ready to buy a deal and know how to buy a deal? Or are they just throwing numbers at you like, X amount of return? So I think, going with a partnership group that wants you to be educated helps them and you be really confident in your investment. Uh, Lastly, I just want to mention taxes and how taxes are structured. So when you invest in an investment, you'll get something called a K1. In that K1, generally year one, you will get a tax deduction, and that comes through cost segregation and accelerated depreciation. Just make sure that those are included in your investments. Just for example, it's tax season. I just got a K1. I had $100,000 investment, and I had about $70,000 of depreciation on that that I can use to in other investments. So just make sure that that's included in a deal. So final statements. Um, so as we've gone through this, we know that price and location are probably the two most important factors of a multifamily property investment. But really, when it comes down to it, it's really the general partners that really are able to drive the value of a deal by correctly operating, and selling the property, and that's really what's going to come out to be what's really going to make the money on the investment. So moving on, just a couple things. We want to let you guys know about our investment opportunities. Like we just discussed earlier, we have our distressed multifamily apartments. We also offer an income fund, which Brian gave a great presentation on yesterday. So I urge you to contact us to get that presentation. And we also invest with a partner on car washes. If you want to invest in any of those investments, you can join our private investment club. And to do that, you need to submit an application to us, and we will give you a call and for qualification. And also, financially, you must be an accredited investor. That means that you have $1 million of net worth, not including your primary residence, or 200K in income as a single person, or 300K as a married couple for the last 2 years. So to apply to our private investment club, please scan this QR code, and you'll get a link straight to our website, and you can apply for the investment club. One more go over on the income fund. So the income fund is always open. It's an evergreen fund. That means that you can invest in it at any time. There's a $25,000 minimum, and you must be an accredited investor. And again, um, give us a text to the number below, and we will give you if you want to learn more, either scan this QR code, give us a text, and we can send you the webinar that Brian put on yesterday, which was really fantastic. Okay, if you have any questions, now's the time to ask. But once again, I want to remind you that you can text this number at 281-559-7061. If you want these slides, give us a text or scan this QR code. Uh, So let's see some of the questions coming in. Let's see. Okay. What makes an apartment distressed? That is a good question. A distressed apartment is uh, apartment comes under distress when a owner can no longer make their payments. It's if they have a loan on the property and they can no longer make their payments. Um, the department is the apartment is distressed. This will occur in a couple ways. One, as interest rates have risen lately, we as these interest rates have risen, it's harder and harder for owners to pay their mortgage and their payments to the bank. So they can no longer make their payments, and now the bank will seize that property or force a sale. Other thing that happens is that if they cannot keep up their occupancy and they're not making enough NOI or net or income, then also they cannot make their debts. So that's how a apartment becomes a stress. Let's see. Another question is, would you invest in an apartment in California? That depends, right? We know that California has bad uh, renting laws for landlords. But if the deal is right, it really kind of comes down to the numbers and again the operator. Uh, I guess that is all the questions for now. I really want to thank you guys for joining our webinar. If you can visit us at our website at headwayinvestments.com or email us at investors at headwaycapital.us. Really appreciate your time. I look forward to seeing you guys again. All right. Thank you.